VAT input is when we bought and the goods come in and we bought from our creditors. VAT output is when we sold and we sold to our debtors. So input is creditors, output is debtors. The first transaction there. Trading stock purchased on credit. Trading stock purchased on credit. So it's your CJ. It's VAT input because we purchased. It's going to look like this. There's 3 accounts there. We bought trading stock. We owe the creditors. And because we bought, it's VAT input. Okay, let's say the amount is 1,000 Rand without the VAT. 1,000 Rand without the VAT. So our trading stock become more with 1,000 Rand. 1,000 times 14 divided by 100 gives you 140 Rand. That 140 Rand is your VAT input, and we owe the creditors 1,140 Rand. There's the big amount. Because we bought, it was VAT input, and it is creditors control. Number 2. Trading stock purchase for cash. Trading stock purchase for cash. We bought trading stock. Because we bought its VAT input. And we've got the bank there. Because we bought for cash. So we bought trading stock to the value of 1,000 Rand. It cost us 1,140 Rand. And the 140 Rand was VAT input. Number 2. Credit sales of trading stock. Credit sales of trading stock. We've got the debtors. We've got VAT output. And we've got the sales. And in the meantime, with the cost price, we've got trading stock. And we've got cost of sales. Okay. We sold to the debtors for 500, and the total sales is 5,000 Rand. 5,000 Rand times 14 divided by 100 gives us 700 Rand. So the debtors owe us 5,700 Rand, the big amount. And the output tax was 700 Rand. The profit markup was 20%. So we take the 5,000 Rand times 100 divided by 120, and we've got a cost. Oh, this is not a nice cost. So let's make it 25%. Maybe it's better. 5,000 times 100 divided by 125. That gives us 4,000 Rand. So the trading stock become less with the cost price of the 5,000, and your cost of sales become more with the 4,000 Rand there. Okay. Cash sales of trading stock the same way, but now the bank is going to be the big amount. So we've got the bank there. We received 5,700 for sales of 5,000 Rand, and the 700 Rand was VAT output because we sold 700 Rand, and then we've got the trading stock and the cost of sales again. I want you to see that VAT input is a plus minus. VAT input is a plus minus. VAT output is a minus plus. Can you see that? VAT output is a minus plus. By the end of the day, we are only going to do this. By the end of the day, it's only necessary for you to do VAT input, VAT output, and VAT control. But you must understand what we're busy doing. Transaction number 3. Vehicles was bought for cash. Vehicles was bought for cash. We bought vehicles to the value of 120,000 Rand because we bought it is input and we pay for it. But what is the amount that we pay? 120,000 times 14% gives us 16,800 plus the 120,000, so we paid 136,800 for this vehicle. The same when you bought vehicles or anything else on credit, then it's exactly the same, and then there will be creditors control, and we owe the creditor 136,800, the big amount. Number 4. Payments of the telephone account. So we pay the telephone account. We've got telephone. Because the service come in, we've got VAT input. And we pay for the telephone. So we say that the telephone bill was 300 Rand. 300 times 14% gives you 42 Rand. And we paid 342 Rand. Can you see that we're busy with VAT input, where we bought the vehicle and where we receive the service. Returning goods to a supplier. This is an interesting one. Okay. Returning goods to a supplier. We've got the trading stock. When we bought this, it was VAT input. And we bought it from the creditors. Okay? It's basically number 1, I think. It's basically number 1. Where we bought. We sent back half of the stock. We returned half of the stock. So the trading stock become less with 500 Rand. The VAT input, 500 times the 14% gives you 70 Rand. And we owe the creditors 570 Rand less. And we stick to the input because we are busy with creditors, because we bought, we are busy with creditors. When we're busy with creditors, it's input. So it's on the minus side of input because we owe the creditors less and our input VAT become less because we returned half of the goods. Goods returned by a debtor. Goods returned by a debtor. We've got debtors, allowances. Number 2 there. Let's say the debtor returned half of the goods. We sold to the debtor for 5,000 Rand. Half of the goods the debtor are not happy. 2,500 times the 14% gives you 350. $2,500 plus 350 gives you 2,850 is the amount that we owe the debtors less. Your debtors allowances on the debit side, output tax on the debit side, debtors control on the credit side, because when we sold, we are busy with the debtors. And when the debtors, we are busy with the debtors, we're busy with output. And when the debtors returned, we make the output less. We make the output less. And the cost price of this is 2,500 times 100 divided by 125. That gives us trading stock become more, cost of sales become less.